According to TI's report, Global Contract Logistics 2011, the contract logistics market saw a strong recovery in 2010. The sector bounced back as most economies experienced positive GDP growth, and there was a rebound in world trade as retailers and manufacturers continued to replenish their inventories. However, as can be seen in the chart, the growth rate in 2010 at 8.4% was not quite back to the level seen before the economic downturn, and the overall size of the market is still below that of 2008. The beginning of the upturn was seen towards the end of 2009 as logistics companies started to benefit from a pickup in volumes and confidence in the industry returned. Our next chart shows that China was largely responsible for the turnaround. It led the industry forward with double-digit growth rates as domestic investment continued and the demand for exports in Europe and North America soared. You can also see that Turkey's manufacturing industry continued to benefit from a strong domestic economy and from its proximity to the European market. It is a popular location for near-sourcing. South America also saw a strong recovery in 2010, although this varied amongst countries in the region. Trade with the US, which was affected during the economic downturn, picked up and contributed to the recovery. In contrast, growth in the developed world was much more muted, although the German market stood out, benefiting from the robust manufacturing-led recovery in its economy. The global contract logistics market was much more resilient during the economic downturn than other logistics sectors due to the defensive nature of the industry, and thus placed the market in a good position for growth as the economy, and in particular trade, recovered. We expect the market to continue growing in a high single-digit range as manufacturers and retailers look to outsource more value-added services. The upturn in the market was mirrored by an increase in profitability, as can be seen from our third chart. A survey of operating margins of some of the industry's largest contract logistics players showed that in 2010 margins rose to an average of 3%. This was the strongest showing since 2007 and shows that the largest companies have been effective at making cost savings. The report also identified the world's leading players. On a global basis, the market leader, DHL Supply Chain, was over 3 times the size of its nearest rival CEVA. The biggest mover in the global top 10 was European operator Norbert Dentressangle, propelled by its acquisition of TDG. We believe there are a number of well-backed and aggressive companies who want to develop their contract logistics business strongly over the coming years. I'd be extremely surprised if this didn't result in further mergers and acquisitions activity in the next 12 months.